All right, breaking news, guys. The Fed is cutting rates again. So, as I've been predicting, multiple rate cuts. It's been widely anticipated by a lot of investors, especially after all these rate cuts. We have our rate increases. Rick Santelli, here we are. So, being interviewed on the rate cut decision that just came out. So, we've got nothing better to do. It's cold and rainy outside, so we're talking about the Fed rate cut decision. I know it's very exciting. But it is exciting specifically for some investors, and I'm going to talk about which investors I believe those are in this video. Now, if we look at the rate cuts here, cutting them for the second straight time to the lowest level in 3 years, that's in fact what's happening right now. So if you remember back in 2022, the Jackson Hole meeting and all of that drama, and then basically after that, interest rates kept on going up. Is essentially what happened. And since then, I mean, we've been in this slowing economy, and they've kind of stabilized at 5% Fed funds rate, and now we're all the way back down to 3.75 to 4% Fed funds rate. Now, obviously, that's going to be good if you're a borrower, if you're looking for mortgages or real estate. So if you're a real estate investor, if you're looking to refinance, that's going to be a good thing. Now, if you're not one of those people looking to refinance in real estate, there are other people who are going to benefit. And one of the people, and I've been talking about this, if you even do like just the AI overview for speculative assets impact on lower interest rates, it even agrees with you. And I'm just going to go over this briefly. So lower interest rates positively impact. And when I'm speaking of speculative assets, I'm also thinking about small cap stocks and other types of stocks that are lower market capitalization that some might view as being more speculative. But lower interest rates positively impact speculative assets by increasing liquidity and encouraging risk-taking as borrowing becomes cheaper and traditional safe haven assets returns diminish. This can lead to increased investment in high-risk assets like venture capital and cryptocurrencies, sometimes creating asset bubbles and potentially increasing financial risk. I just made a video about Bitcoin and the current super cycle. They are talking about Bitcoin potentially hitting 200,000 by the end of the year or early next year. That's kind of been my prediction, at least like 150. I think we can get to 150 in this cycle. And then if you go back to the next cycle, it might be 500,000, it might be 1,000,000. But you know how these things go through retracements. We've seen Bitcoin go down by 70 to 90% and then come back, etc. But really with, you have increased liquidity. This is something I've talked about for a long time. Lower interest rates, especially when caused by central bank rate cuts, they are going to inject more money into the financial system. You have a higher risk appetite, so interest rates, when they're low, the opportunity cost of holding cash is lower, and returns on safer assets like bonds decrease, which pushes investors towards riskier assets. So you can look at bond yields as a determining factor as well, the risk-free rate versus what investors can get outside of the risk-free rate. You have cheaper borrowing, so businesses and individuals can borrow money at a lower cost, which can fuel more investment in speculative assets. And then asset inflation. The increased wall of money chasing a relatively fixed number of speculative opportunities can lead to a rapid increase in the prices of these assets. Now, with the wall of money, yes, there's more money that can be stimulated in the economy, more borrowing, and it's debt-based monetary system. But also think about like the stimulus checks when all that kind of stuff came out. If they were to do some type of universal basic income or whatever, I mean, or what maybe people actually use it to pay their bills, but a lot of times people just end up gambling or, buying stuff with it. So don't be surprised if some of that money would make its way back into the market. So that's also when I think about like a wall of money, not just the increase in borrowing, but also if they were to do some type of stimulus check again or something like that, that could be something else that would help out speculative assets. Now, we're not nearly as low as we were previously in terms of interest rates. Back in 2021, 2020 in particular, when interest rates were lowered down to 0% during COVID, that type of market was fueled, the frenzy on top of all the new money, that wall of money chasing with all the lower interest rates. I mean, that was just a speculative frenzy. So to see something like that again, I think we'd have to get back down, lower on interest rates. And then also you'd want to start introducing more money into the economy. Of course, there's risk of inflation when that happens. So we don't want that. But asset price inflation has already occurred. I'm talking consumer price inflation. That's the big risk. So what are potential negatives of what's happening, though, if you lower interest rates? Well, asset bubbles, and I'm going to talk about specific indexes here in just a minute that you should watch in terms of small cap stocks. So potential negative impacts, right? Asset bubbles, increased leverage, people taking more risk because the cost of borrowing is lower. Diversion of resources. So speculation can divert capital and resources away from more productive economic activities. And then systemic risk. If speculative investments become a significant part of the financial system, a major failure in the speculative market could have far-reaching economic consequences. So there it is. Now I want to I've talked about Bitcoin in the last video, kind of went over gold versus Bitcoin. I think this interest rate move should help Bitcoin to some degree. I'm curious how it's trading actually after the announcement. If we look at the price of Bitcoin, it's down. Okay. I think it was down earlier too. So we'll see what happens there. Over the last 6 months, you can see the return over the last month and all that on Yahoo Finance. But if we come on over here to the Russell. Now, this one in particular is up 17.98% over the last year. Last 5 years, up 103%. This is one of the markets that more recently is just now breaking out. If you go back to July, June, all those months previously when I was screaming that small cap stocks are just now at the cusp of a breakout, well, here we are. I mean, the Russell 3000, this is the 3000. There's also the 2000. If you look at the Russell 2000, not quite as high, though, as the Russell 3000. So you can look at specific indexes. You can look at opportunities in terms of those ETFs. This one right here, it looks like is just, in fact, now breaking those all-time highs that we've seen over the last 5 years. In fact, that is pretty much the all-time high because 2021 was the previous time we got up to 2,200. So we're just now trading at 2,500. So I think the Russell 2000 is one that could outperform. I also think the S&P 600 is very undervalued still. If you not even hitting the all-time highs, the S&P 600 index in particular could outperform all of them. That's just my guess because if you look at where it's trading at right now, we are just now getting back to those highs in 2021. 2024, we hit like roughly 1,500 double top. So if we break the all-time high this time of 1,500, we're right there. I think, as stocks are pretty much at record highs today, I know that the S&P 500 is rallying, the NASDAQ is rallying. If you look at all the indexes following the news, now it's kind of flat. I think it was trading higher earlier in the day, but they still are trading at record highs. Now, but the S&P 600 is one that I would watch. I'm very bullish on small cap stocks still, and especially with some of these indexes like the S&P 600. Specifically also, if you look at the Russell 2000, the Russell 3000 has had a better performance than the other ones, like over the last 5 years, up 103%. This is up 63%, the Russell 2000 in the last 5 years. And then this one is up 67% over the last 5 years. Now, the NASDAQ, for comparison, is up 113% over the last 5 years. And the S&P 500 ETF, if you look at that one over the last 5 years, is up 111%. So as you can see, small caps have significantly lagged behind. So what is my prediction with interest rates and with speculative assets or more risky assets becoming more favorable as interest rates continue to go down? Well, my prediction is going to be not just the indexes. You can actually benefit by purchasing ETFs that track these specific indexes if you want. But you can even do so on a leveraged basis if you want, based upon your risk tolerance and investing goals, of course. Not a recommendation of any kind. Please see the disclaimer below if you're interested in learning more about who we are as a company and what we do. But when we think about these indexes, and with the interest rate cuts coming, yes, it's going to be cheaper to buy real estate. It's going to be cheaper to borrow. If we assume that the bull market's continuing, if we assume that AI investment is continuing, if we assume that all of this is going to be beneficial for AI stocks and in particular small caps that are also AI stocks, there's going to be a lot of growth in these small caps. So that's what I'm watching right now. I'm watching these indexes. I'm positioning myself. I'm invested in small cap stocks personally. I've been very bullish on them for a long time. I just feel like they've lagged behind. And now that we're getting lower interest rates, now that the Fed finally came out and lowered interest rates a second time, so the lowest level in 3 years, I mean, here we are. The ball is in motion. And if we get more interest rate cuts, it's only going to help out even more. So that's my thesis on where I'm investing with interest rates being cut. And I'm going to continue to invest in small caps because I think they've lagged behind. I think they're going to come back. And I think these indexes in particular, the S&P 600, and also watch the Russell 2000. But then in particular, you can actually dive into the specific companies if you want, if you're interested in buying those companies individually. So anyway, guys, the Fed has lowered interest rates once again, second time in a row for the lowest level in 3 years. Here we are, guys. It's finally in motion. Let me know what you guys think in the comments down below. I think speculative assets are going to keep on doing well. They're going to outperform as we see lower interest rates and higher liquidity flood the market. What do you guys think? Let me know in the comments down below. Thanks for watching, guys.